Welcome back to The Explainer. Okay, today we're unpacking something genuinely fascinating. When most people hear the words Agricultural Bank of China, or ABC, they just picture a massive traditional state-owned bank. But if you actually look closely at the data, it's a completely compelling investment paradox, just waiting to be unraveled. It defies some of the biggest assumptions about the Chinese economy right now, and by the time we finish today, you're going to see exactly how this institution is operating a hidden engine that most investors are completely overlooking.
All right, let's dive right into our roadmap. We're going to cover the setup, how they're surviving the property crisis, the paradox of shrinking margins but growing volume, the digital yuan revolution, their high yield and low valuation, and finally, the real risks and our verdict. Let's get to it.
Okay, part 1. The setup. A financial behemoth.
So, to really grasp what the Agricultural Bank of China is doing, we've got to look at the big picture of China's new normal economy. This isn't the wild hyper-growth era of the 2000s. We're in a highly strategic, calculated environment now. Just think about this number for a second. 40 trillion. That is 40 trillion RMB in total assets. It's almost hard to wrap your head around, right? ABC is an absolute titan of liquidity. But look, just being massive doesn't guarantee success. It's all about exactly where that giant pool of capital is being deployed.
Right now, China is steering toward a GDP growth target of 4.5% to 5%. And to hit that mark, the state is going all in on two main things: rural revitalization and technological self-sufficiency. So why does this matter for us today? Because ABC sits right smack in the middle of these exact national priorities. They aren't just reacting to the economy, they're literally the vehicle driving it forward.
Moving on to part 2 and our first paradox, surviving the property crisis. Look, we've all seen the headlines, right? The real estate struggles in China are no secret. So how on earth can a massive Chinese bank seemingly thrive in that kind of environment? It's the elephant in the room. With local government debt and heavy property exposure dragging down the financial sector, how is ABC's non-performing loan ratio sitting at a historically low 1.32%? Honestly, at first glance, it doesn't make any sense. But when you dig into their filings, they tell a very clear story of how they're pulling this off.
It basically boils down to a two-step mitigation strategy. Step 1, ABC has been incredibly aggressive. They accelerated the proactive disposal and write-offs of their distressed real estate assets in the first half of the year. They aren't just sitting around hoping bad debt magically fixes itself. And step 2, which is even more vital, is geographic diversification. They are leaning heavily into rural and agricultural loans, which are fundamentally a whole different ballgame compared to risky commercial real estate. And this creates a pretty stark contrast. Think about your typical city-level commercial banks. They're super geographically concentrated and highly exposed to local municipal real estate debt. But then look at the ABC advantage. Because their massive rural loan book is heavily subsidized and actually guaranteed by central government policy, it acts as this incredible safe harbor buffer. They've built up a protected moat that those city-centric banks just do not have.
And the ultimate payoff of that strategy? A staggering disparity in provision coverage. While the standard regulatory requirement is 150%, ABC is sitting pretty at nearly 300%. Basically, they have a threefold cash buffer. That gives the bank extreme resilience to absorb sudden macroeconomic shocks without breaking a sweat.
All right, part 3, our second paradox, shrinking margins, growing volume.
So, to stimulate the broader economy, the People's Bank of China, the PBOC, has been cutting rates. Usually, when interest rates drop, banks really struggle to grow. And yes, those PBOC rate cuts are absolutely putting downward pressure on banks. For ABC, we're projecting a slight net interest margin compression, probably dropping roughly 10 to 15 basis points this fiscal year. I mean, ABC is definitely not immune to financial gravity. But here's where it gets really fascinating. How do you mitigate those shrinking margins? Well, you do it with massive volume in priority sectors like manufacturing and green energy, and, most importantly, with incredibly cheap funding. Nearly 60% of ABC's funding comes straight from rural retail savings accounts. We're talking about low-cost, ultra-sticky current account deposits. They don't have to rely on expensive wholesale funding. Honestly, this kind of cost-to-income advantage is something European and American banks can literally only dream of.
Which brings us to part 4, the hidden engine, the digital yuan revolution.
Now this is where the long-term story gets wild, revealing a futuristic technological moat. 100 million plus. Just let that number sink in for a second. That is the staggering number of ECNY, or digital yuan, wallets that ABC has already onboarded. Guys, this isn't some tiny pilot program anymore. This is a massive, real-world deployment of a central bank digital currency.
So why does this actually matter to you as an investor? Let's break down the strategic advantages. The government is essentially mandating the use of the digital yuan for things like agricultural subsidies and rural pension payouts. And because ABC is the dominant bank in these regions, they are the mandated conduit. This digital shift completely slashes the massive costs associated with handling physical cash. But even better, as the rural economy formalizes digitally, ABC is perfectly positioned to rake in a huge new stream of transaction fee revenues.
The whole thing is captured perfectly in this quote. This is not just a bank. It is the fiscal backbone of China's food security policy. They are literally becoming the core payment processor for the entire food supply chain of the country. That blend of digital and physical infrastructure creates a moat that is virtually impossible for any foreign or private bank to penetrate.
Moving to Part 5, the payout. High yield, low valuation.
Let's talk about what all of this actually means for your portfolio. We've established the moat, we see the resilience, but how is the market actually pricing this? Well, for income-focused investors, here is the opportunity. Right now, ABC is trading at a price-to-book ratio of roughly 0.4x. That strongly suggests the market is severely discounting the stock. It's like everyone is pricing in a worst-case scenario based on geopolitical risks and the property market headwinds we talked about earlier. They seem to be completely ignoring the state-backed guarantees and the massive untapped potential of that rural digital credit market.
And because of that dirt-cheap valuation, combined with the fact that the bank maintains a 30% payout ratio of its net profits, the forward dividend yield is sitting at over 8.5%. To put that into perspective, compared to the 10-year Chinese government bond, which is hovering around 2.7%. For any investor seeking yield, that is a massive spread that absolutely demands your attention.
Finally, Part 6, the reality check, risks, and our final verdict.
Of course, no investment is totally bulletproof, right? It's super important to impartially weigh the data and go over the real risks required for this kind of macroeconomic analysis. So, looking ahead at the next 90 days, here are the key catalysts and headwinds you need to be watching. First, keep an eye on the timing of any PBOC reserve requirement ratio or RRR cuts. Second, pay close attention to the official Q3 2026 earnings release. As always, verify the financial data directly through the HKX and Shanghai Stock Exchange filings. Third, you've got to remain vigilant about RMB to USD exchange rate fluctuations. And finally, keep monitoring the actual on-the-ground pace of the domestic property recovery. Remember, forward-looking statements are always subject to shifting market conditions.
Which leaves us with one final thought to ponder today. When you factor in the 300% provision coverage, the massive shift to cheap digital yuan funding, and that juicy 8.5% yield, is the market's worst-case pricing blinding investors to the ultimate rural credit moat? It is a fascinating paradox and for sure, one well worth investigating further. Thanks so much for joining me on this explainer. Keep learning and I'll catch you next time.